Would you like to hear the secret to success?
Of course, yeah.
Of course you would. Now here you go. Figure out how score is kept and play the game accordingly. Figure out how score is kept and play the game accordingly. Now we'll use a real simple example here. What is the only thing in baseball that gets you a point awarded?
Touching home plate.
Yeah, you've got to go across that home plate. You've got to get a run, right? Does that make sense? Okay, so when I was a little kid, my family's not really sports oriented, but they thought that I was awkward and needed help, so they threw me into this baseball team. And I was great at getting walked. I was also great at getting hit by the ball, but I didn't mind because I got on base, right? Now, so got on base, and then I get to second base, and then the third out, and I'm like, hey, coach, how many points did I get? He says, you didn't get squat. Because that's how we talked in the 70s. He says, you didn't get squat. And I'm like, what? He's like, no, you got to get a run. I'm like, what's that? And he explained to me about the run and how it all worked. And then that's how, after that, what am I going to be focused on trying to accomplish? I'm going to be focused on trying to accomplish that thing. Wherever you go, you need to figure out how score is kept and play that game accordingly. So, for example, here at the College of Business, score is kept for professors in peer-reviewed journal articles. And you got to have 6 of those to get to tenure, and you got to have 6 more to get full professor and that sort of thing. And the other thing is we have to get 3 of those in any rolling 6-year window to maintain our faculty qualification. And the punishment, if I don't, is that I have to teach extra classes. Do you think I want to teach extra classes? No. Now, I've actually kind of screwed up because in 2025, I will have 5 of these things. Now, that's going to keep me clean until 2030. But after that, then I'm going to, and by the way, all those are going to go away, right? I would have been so much better off to have tried to spread those out 1 every other year. And that way I would have always kept my 3 in the rolling 6-year window. So figure out how score is kept and play the game accordingly. Any questions? Okay, let's talk about financial statement and ratio analysis. So, if I tell you there are 2 companies and one of them has net income of $10 million and one of them has net income of $100 million, can you tell me which company is better run? No, you really can't, because they might be different sizes, they might be in different industries, there might be all sorts of different things that would keep us from being able to compare them directly. And we also need the ability to compare the same company over time. And you say, well, wait a minute, that might be pretty easy. You just look at what was it a year ago versus what is it today. And let's say that the net income was up by 3%. Maybe you're happy. But what if during that time sales were actually up something like 20% and your net income is only up 3%? Well, then that would be an indicator of a problem. And so we've got to find ways to be able to compare between companies and also compare between time periods for the same company. I'll give you a good example of one that's really resistant to comparison without making adjustments in that. You cannot compare Apple one year to the next simply because they grow so fast. Okay, any questions so far? So let me tell you about my own situation. Well, this is the last company that I worked at. It was a little company called Americhem. And I've told you what we did. We made those little color concentrate pellets that go into making plastics of different colors. And it turns out we had a competitor across town. We were in Cuyahoga Falls, they were in Akron, and they were called Poly One. And Poly One was publicly traded. What does that mean about their financial statements? Yeah, they have to publish them, so I can get my hands on their financial statements, yet we are a privately held company. What does that mean about their access to our financial statements? They can't get it. Oh, for shame, he's late. You really need to work on this. I like that code, but you really need to work on this. First 4 rows only, please. Okay. Now, Poly 1, I've got their numbers. They don't have mine, so that's good. Now, here's what you need to know, though, about the Poly 1 was many orders of magnitude larger than us. It would not have made sense for us to look at our net income and say, well, it's less than theirs, so we must stink. Or our sales are less than theirs, so we must stink. But we can do financial statement analysis and ratio analysis to get us into a situation where we can start to make some realistic comparisons. And as we go through these different things, I'm going to tell you about where sometimes these comparisons might not necessarily work out, simply because of what's called economies of scale. Are you guys familiar with economies of scale? How can Walmart get stuff so cheap? They buy a bunch of it. Did you know, so Costco usually has the lowest gas prices in town. Did you know they also have the highest profit per gallon? How can they pull that off? They sell a boatload of gasoline, right? So they get the best price possible. So there are economies of scale that we'll see will somewhat mess up our analysis. Now let's start with the simplest, and that would be the common size financial statement. I've got these 2 companies, and I want to compare them, and so I've got their financial statements. What is the easiest way I can do comparisons? And the answer is the common size financial statement. And we're going to focus on the balance sheet and the income statement. And what we're going to do is, on each of those, identify a single number that we can divide everything by. So now everything is in terms of basically a percentage of that number. On the balance sheet, if you had to guess, what are we going to divide by? By the way, you don't have to guess, it's on the total assets, right? Because this side all adds up to total assets, and over here we have debt and equity, and that adds up to total assets. We are going to divide everything on the balance sheet by total assets. Now we can start to look at things like our inventory. Our inventory was 20% of our assets. Maybe their inventory is only 5% of their assets. Might be the first sign that we've got an issue with inventory. We could also look at the percentage of debt that we use to finance our firm. Maybe they're at 50% and we're only at 20%. We might be foregoing some of the benefits of debt. By the way, the biggest benefit of debt is that you can write the interest off for your tax purposes. And so there's a tax shield with debt. Okay, so we can do that. Now, let's move on to the income statement. If I'm going to choose one number on the income statement to divide everything by, what should it be? Yeah, total sales. But here's what you need to know. The top line on the income statement, the name is hardly ever just total sales. And a lot of it has to do with what the company does. So for instance, in our case, it was total sales at American because we really didn't have to worry about returns. However, if you are in retail fashion, what do you think happens? Does everything that you sell stay sold? No. My wife, she has this thing. She doesn't like to go to the store. She'll look at stuff on Amazon and she sees a dress she likes. Does she know what size it is? She doesn't know anything about how the sizing runs, especially since it's usually from China. And in Chinese sizes, my wife either wears an extra, extra large, an extra, extra, extra large, or an extra, 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 extra large. Not that my wife's a big person, but Chinese sizes run small, right? So what does she do? What do you think she does? Yeah, she orders 3 at most. How many of those is she going to keep? 1 at most, right? And so you end up with a lot of returns. When you're doing retail sales like that, instead of reporting total sales, you report net sales, which is total sales minus returns. Okay, what if you were an accounting firm? Maybe it would be auditing revenue would be your top line, but it's going to be basically different. How do I know then what I'm supposed to divide by? It's always the top line. It's always the top line. We always divide by the top line. Okay, now we can learn a couple of things with the income statement. One of the things on there is the cost of goods sold. And our cost of goods sold at Americam was going to be higher than at Poly 1. And there was a simple reason for that. It's getting back to the economies of scale. We were buying our plastic pellets in 25 kilogram bags. That's 55 pounds for you Americans. We were buying them 55 pounds at a time. Poly 1, because they were so big, could buy plastic 40,000 pounds at a time from a rail car. Who do you think was paying less per pound for plastic?
Poly 1.
Yeah, Poly 1, definitely. There's no packaging involved. The transportation is cheap. I mean, there's all sorts of reasons. Now, in the meantime, though, they had to store that, right? They had to store the 40,000 pounds of plastic. But they were cranking stuff out so fast that 40,000 pounds would hang around about as long as our 55 pounds would. Now you say, well, wait a minute, why don't you just at American, why don't you just build some silos and go out and buy your stuff 40,000 pounds at a time? And the answer is inventory. Do I want to hold that much inventory? No. How many years would it take us to burn through 40,000 pounds of plastic? I mean, literally, it would have taken us years to have gone through that much of any single type of plastic. And so, even though we were doing our best to be efficient, we would never be able to have a percent of sales as cost of goods sold as our competitor. Now the next one down that we usually talk about is selling, general, and administrative expenses. And I was part of that there at the end when I was doing my selling, because my salary, my travel, my commissions, all came out of that. The CEO salary, the secretary salary, all that sort of stuff came out of selling, general, and administrative expenses. What if I look at my company and we've got 37% of our total sales is selling, general, and administrative expenses, and the other people are running at 4%. Do you think we have a problem? Oh, very definitely we have a problem. So these are just the sort of things that you can get from these common size financial statements. Are there any questions? Okay, now let's get on to financial ratios. So, common size financial statements are really good if you're comparing just the things on one financial statement. But sometimes we have to do things that cross financial statements. For example, what financial statement would I find inventory on? Yeah, the balance sheet. But where am I going to find the sales? On the income statement. Now, what is the only reason that I hold inventory? Any ideas? I'll get you started. To produce
Sales.
sales. The only reason I hold inventory is to produce sales. So if I'm going to try to figure out my inventory performance, I'm going to have to be looking at both the sales from the income statement, and I'm going to have to be looking at the inventory from the balance sheet. And you can't get that out of a common size financial statement. And so then we end up with expanding this concept out to what are called financial ratios. Financial ratios. And that allows us to look at things that are a little more complex. Now, who is the consumer for these sorts of things? Who's calculating them? Who is using them? Well, the first thing is competitive analysis. And that's what I was just talking to you about between American and Poly 1. We would get a hold of their financial statements and we would do these ratios and compare our performance to theirs across many different ratios. Then there's also internal analysis. Every month when I was a production group leader with Halliburton, I had to sit down with my accountant, Jack. And Jack and I would go over my ratios, and Jack would tell me where I was slacking and tell me where I needed to pick up my heels. And so it's good for internal analysis. And then there is this broad category called external analysis. That's for people outside the firm. And the first group we would refer to as equity analyst. Equity analyst. Ms. Sego, what does an equity analyst do?
They analyze.
Oh, she is so clever. They analyze equity, right? But what are they trying to figure out? Any ideas? No? Okay. So equity, what are they?
Are you trying to figure out how to gain money to pay for assets?
Oh, okay. Well, how about this? Have you ever heard of the buy, hold, sell ratings on stocks? Do you know who comes up with those? Equity analysts. And so they're basically trying to figure out if the stock is underpriced or overpriced. Now, I would tell you that equity analysis for you guys, if you think from this class you're going to be able to go out and analyze firms and then make extra money through, no, absolutely not. And the more you know about finance, the more you'll know that's true. But we do have these equity analysts, and they spend their entire lives thinking about one industry. And that industry may only contain 3 firms. And so there is a chance that they actually know something that you don't, and they may actually have some information in their buy, hold, and sell ratings. And in fact, we know that there is a little information in these buy, hold, sell ratings, because if someone switches a buy recommendation to a hold or a sell, what immediately happens to the stock price? It goes down. The market actually believes that there is information in these ratings above and beyond that which has already been put into the stock price. And so that's what these equity analysts are doing. Now, we also have suppliers. Why in the world would suppliers be concerned about my financial ratios?
Selling on credit.
Yeah, they're selling on credit. They want to get paid, right? And so they're going to be doing this sort of analysis. And further and beyond them, there is a company called Dun & Bradstreet. Just like when you go down to the car lot to buy a car and they look up your credit report, when you get a new customer, you can look up their Dun & Bradstreet report, and you can see how good they are at paying their bills. And they'll talk about how many of their customers or of their suppliers reported 30 days past due, 60 days past due, and so on. And I actually got a call from these people one time asking me about one of my customers and how they paid their bills. And so I know how the report is put together. They call around and build this web of information. Okay, so that would be where these suppliers might be getting their information for privately held firms. For publicly held firms, they can just go out and look at the financial statements. And then we have banks. Banks are loaning companies money, either short-term or long-term, and banks are also interested in getting paid back, so they're going to be interested in your financial health. And then we have bondholders. Bondholders are interested primarily in your ability to pay interest. We'll talk about why they're not so concerned about principal when we get to those measures. Are there any questions about who might be interested in these measures?
What was that thing you said about the privately held companies that they rent up?
Oh, privately held companies, if you want to learn about their credit worthiness, you look at Dun & Bradstreet. Dun & Bradstreet. And usually people will talk about it as the D&B sheet or the D&B report, but you know, it's Dun & Bradstreet. Does that help you out? Yeah, cool. Other questions? Okay, now we are going to see that these ratios fall into families. Now, in my family, I've got a mom, a dad, and a sister, and me. In that family, we are similar, but we are not the same. And we're going to see here that, because, you know, we've got shared genetics and all that, here we're going to see that these ratios that are in families are similar but not the same. And by the way, every formula I show you in this class should be on your note sheet for your exam. Every formula I show you in this class should be on your note sheet for your exam. And I would advise you to put them into the families when you've got them on your note sheet. That'll help you narrow things down more quickly during the exam. So what is short-term, by the way, solvency. Solvency is your ability to pay your bills. Liquidity, it's the same idea. We use those terms interchangeably, although we do have other things we talk about with liquidity. Let's talk about the current ratio. We say these are short-term solvency measures. What is short-term in finance and accounting?
Less than a year.
Less than a year, right? Now, what do we know? Come on. What do we, stop that. Okay, what do we know about current assets? How long before we expect to collect that cash? Yeah, 1 year. Now, what about current liabilities? How long before we expect to pay that cash? 1 year. And so we have this very basic measurement of short-term solvency being the current ratio. Now, in a healthy company, the current ratio is going to be greater than what? Yeah, it's got to be greater than 1 because we want our current assets to be more than our current liabilities. We want to have more than enough money coming in over the next year to pay our bills. However, we're going to see that that's not quite the best measure because not all of our current assets will necessarily turn into cash over the next year, but you can bet your socks, I'm trying to throw something nice in there, you can bet that current liabilities are all going to come due. Because those are out there and you know you've got to pay them. So that means you could have a current ratio greater than 1 and still find yourself in trouble. And so we need to make some more conservative measures here. And our first attempt at that is the quick ratio or acid test. The quick ratio or acid test. The quick ratio or acid test backs out inventory from the current assets. It backs out inventory from the current assets. And there's a good reason for that. Do you think that necessarily all of our inventory will sell within the next year? No. In fact, when I worked at Halliburton, we had last manufactured this one particular pump in 1957. And by the time 1994 rolls around, the only ones left in existence still in service are in a country called Vietnam. This is not a joke, it's a true story. These pumps were in business in Vietnam. However, back then, because the United States and Vietnam had a disagreement back during the 1960s and 70s, we still had a trade embargo. So we had spare parts on the shelf from probably the early 1960s that were not ever going to be used until we got better relations with Vietnam. Now, I've got bad news for you. We actually gave up and scrapped the parts. And then Bill Clinton announces better relationships with Vietnam, and we're like, okay. Now, my point to you is this. Not necessarily all of your inventory will sell. So if we want to be conservative about it, we could figure out the quick ratio or acid test. Now, here's the interpretation. If the quick ratio is greater than 1, if the quick ratio is greater than 1, then I can pay all of my bills over the coming year without selling another single piece of my inventory. If a quick ratio is greater than 1, then I can pay all of my bills over the coming year without selling another single piece of my inventory. Now, at a healthy company, do you think it's realistic to think that you're not going to sell any of your inventory? No. And so just because the quick ratio is less than 1 doesn't necessarily mean the company is unhealthy. but one that's greater than one lets you know that they can pay their bills over the coming year without selling any of the inventory. Now, let's assume that you were ultra crazy, conservative, and you wanted to make sure that they could pay their bills. Well, you could calculate what we call the cash ratio. And the cash ratio is just cash divided by current liabilities. It's just cash divided by current liabilities. And what that says, if that's greater than 1, it says I can pay all of my bills over the coming year without selling another single piece of my inventory and without collecting any of the receivables from my customers. Because after all, current assets, the big 3 are cash, inventory, and accounts receivable. If my cash ratio is greater than 1, I can pay all my bills over the coming year without selling another piece of inventory and without collecting any money from my suppliers. Now, what do you think? Do you think there are many companies out there with a cash ratio greater than 1?
No.
No. In fact, I should go out and calculate it just for fun. The cash ratio for Walmart. I'll bet it's pretty low. Why? What about their accounts receivable? Do they ever let you? No, actually it's quite low, right? Who are they selling to? Oh, no, who are they selling to? Right? You guys, right? I'm pretty sure we all have gone into Walmart at one time or another. Now, did they give you 30 days to pay? No, when did you have to pay? Right then. In fact, that person's looking over your shoulder at the self-checkout, making sure you're not, stealing a pack of chewing gum or some crap, right? They're very picky. They want to be paid now. So their accounts receivable are quite low. What about their inventory? Yeah, it's high. Those stores, they got stores out the ear, coming out their ears, and they've got inventory in each one of the stores. It's just huge, right? But they're selling it, quite a lot of it. And so they're not really having to worry about not selling any of their inventory. In fact, do you think Walmart would tolerate having something on its shelf that didn't sell every week? Probably not. Okay, so who's interested? Suppliers. Why are suppliers interested? Because they're loaning you money on the short term, 30, 60, 90 days. If you're going to be alive over the next year, chances are you're going to be alive for the next 30, 60, 90 days. And then more generally, any short-term creditor. For instance, you can sell debt in the public market that's very short-term. It's called, I've lost it here, commercial paper. It has 270 days or less to maturity. That's just short-term debt. If you were going to buy commercial paper from a firm, you would want to look at these things. And what about banks loaning you working capital? They would be interested in these things too. Questions so far?
Is there any particular reason why the quick ratio can also be known as the acid test?
Okay, so in finance, we have many names for the same thing, and then we have the same name for many things. And so you probably had a group over here that preferred to call it the quick ratio, and you had a group over here that preferred to call it the acid test, probably hippies, right? You guys know what acid is? Okay. So eventually, though, all this kind of gets merged, and now we have to call them by both names.
Fair enough.
It's kind of like being British. My British people, what do you guys call that box that goes up and down between the floors in a building?
A lift.
A lift!
Does that lift you up and down?
Yeah. Well, we call it an elevator because it elevates you up and down. Doesn't that sound better? I'm sorry. Now, what is acid test? So if you go back to testing metals to see if they're precious or not, if you put acid on gold, what's going to happen? Nothing, right? You put acid on some of the crap that looks like gold, that's not gold, it fizzes, right? Yeah. By the way, don't play with acid. Either type. Okay, now we're on to long-term solvency measures. In accounting and finance, we say long-term is?
More than a year.
Yeah, more than a year. Now, we're going to start out by talking about, and by the way, we have two subfamilies here. So these leverage measures, you can think of them as brothers and sisters. You can think of the interest coverage measures as brothers and sisters. But those two groups are cousins, right? So you can think of it in the family way there. Okay, now let's talk about leverage. Leverage is all about the proportion of your capital structure that is composed by debt. It's the portion of your capital structure that is composed by debt. And for my two British people, you may also have heard this called gearing. Gearing is the British term for this. This is the first time I've actually had British people in class, and two of you. It's very strange.
Who's the other British person? Hi, where are you from? Oh, okay.
You mean you guys can't spot each other? Yeah, sometimes you go to China and you run into another person that looks like me and you're like, oh, hey, you're American. And they're like, no, we're Canadian. Like, sorry. And you could tell they were pissed, right? Back to the story. Okay, so the first one, the simplest one, the one that I like best is the total debt ratio. The total debt ratio. And it's just total debt over total assets. Why would we say total assets minus total equity? Here's why. If I do total assets minus total equity, it makes sure that I am capturing the current liabilities as part of the total debt. If I just do total debt over total assets, students will be tempted to just use the long-term debt. But that's not total debt. We're looking at total debt, which would include the current liabilities. So we're looking at current liabilities plus long-term debt would be our total debt. How can you make sure you get that number correct? Just take the total assets and subtract out the total equity. Now, the total debt ratio is real easy to interpret. If it's 0.4, that means that 40% of the assets are financed with debt. If it's 0.7, it means that 70% is financed with debt. Now, if I am loaning you money, who would you rather loan money to? Someone that owes a lot of money to a lot of people, or someone that owes very little money?
Little money.
Yeah, little money, because why?
You don't owe a lot of money to a lot of people. So-
Okay, but what does that do for you as someone who's loaning out the money to this person? Yeah, your chances of getting paid are much greater if they don't owe everybody else in town. Does that make sense? And so if I am a lender, I want to loan to someone with a lower total debt ratio. But I'm going to tell you that if you are the borrower, you are not necessarily interested in having the lower total debt ratio. Remember earlier I talked to you about the tax benefits of debt? Because we can write that interest off. It turns out that for a given industry, there is basically an optimal level of debt that balances off this tax benefit of debt with the increased risk of bankruptcy. And if you get those perfectly balanced, you've got an optimal level. And while your bank might want you to have a total debt ratio of 0, if you are an electric utility, it should probably be something more like 0.4 or 0.5. What do you think the total debt ratio looks like at banks?
Point.
Ooh. How about this? Let me ask you this question. Would you loan money to someone that had a total debt ratio of 0.9? You guys say no. Ms. Wainena says no. Ms. Wainena, do you have a bank account? Yes, you do. I have some bad news for you. You are loaning money to someone with a total debt ratio of 0.9. Now, how could banks get by with that? Well, the trick is they have extraordinarily well diversified portfolios, right? You think they're just loaning money to one person? No, they're loaning money to lots and lots and lots of different people. And by the way, are they doing all their loans in particularly one industry? No, in fact, they're supposed to have it spread out. And if you guys remember back to Silicon Valley Bank a couple, 3 years ago, what led to their problem? They had an undiversified portfolio. And you saw how that ended for them. Most banks are smarter than that. So if you have a bank account, you're already loaning someone with a 90% total debt ratio. Okay, now what about the debt to equity ratio? Well, we can calculate, it's just total debt over total equity, and we can calculate that total debt in the same way that we did for the first one. Now, debt to equity ratio, I hate this measure. I hate this measure. You don't need to remember why I hate it, but here's the reason I hate it. It has a nonlinear response to changes in debt. So for instance, if I've got a firm that's half debt, half equity, right now that debt to equity ratio is 1. What if I raise that to 60% debt and lower it to 40% equity? By the way, those always have to add up to 100%, right? If I do that, now the debt to equity ratio is 1.5. And so basically for a 20% increase in the total debt ratio, I have a 50% increase in this thing. So it's got this squirrely nonlinear relationship with debt. That's why I don't like it. Why do I teach it to you anyway? Because everyone and his dog talks about debt to equity ratio. You'll be watching CNBC. They're like, oh yeah, the debt to equity ratio is terrible for this firm. And they all talk about it. So that's why I teach it to you. And there's one more reason that I teach it to you. And that is that you can actually use it in the calculation of the third thing that's up here. The third thing that's up here is the equity multiplier. The equity multiplier is just total assets divided by total equity. Total assets divided by total equity. But here's the cool thing. Total assets is just equal to the total equity plus the total debt. Can we all agree on that? Okay, now I'm going to divide, of course I've got to divide these both by TE. That's the distributive function of mathematics, or distributed property. What can I do now?
Cancel out.
Yeah, I cancel out right here. This goes to 1. And so now we see that this is actually just 1 plus the debt to equity ratio. Do you see that? Okay, so you're going to be having a homework problem, an exam problem, where you need the equity multiplier to solve it, but I haven't given it to you. And this is what you're going to think in your head. That bastard did not give me the equity multiplier. Now, as soon as you have that thought, I want you to start looking for the debt to equity ratio. I want you to start looking for that debt to equity ratio because in order to get your equity multiplier, all you have to do is add 1 to the debt to equity ratio and you are there. Now we're going to see that this equity multiplier it's going to show up over and over again. We're going to see that the return on equity is equal to the return on assets times this equity multiplier. We're going to see that the beta on a firm's equity, which you guys probably don't even know about yet, is equal to the beta on the assets times the equity multiplier. It just shows up over and over again. And every time it shows up, I want you to remember it's just 1 plus the debt to equity ratio. Questions? Okay, so those are the leverage rate measures. If I'm loaning money to you, I want those all to be lower, right? Now, what about the interest coverage measures? Well, they're all about your ability to pay your interest over the coming year. To pay your interest over the coming year. Now, the first one we look at is the times interest earned ratio, or the TIE ratio. Now, what is it? It's just earnings before interest and taxes divided by interest. Now, what does this mean? If this is greater than 1, it means you'll be able to pay all your interest over the coming year. That's the interpretation. If this is greater than 1, you'll be able to pay all your interest over the coming year. And you say, wait a minute, it's earnings before interest and, what's the T stand for?
Taxes.
Taxes. You say, wait a minute, Haggard, you got to pay your taxes. Here's the problem. What if my earnings before interest and taxes are exactly equal to my interest? what happens then? What does my taxable income become? 0. I'm going to ask our local accountant here, what's the tax on 0?
Oh, 0.
0, right? And so it doesn't matter at that point that you've got you're not paying taxes because you've got no taxes to pay. Okay, now, similar to some things we've looked at earlier, there is a but wait a minute in this. And that but wait a minute has to do with the fact that earnings before interest and taxes has depreciation subtracted out. Is depreciation a cash expense? No. Depreciation says that we spent some money in the past, right? And we're just spreading that cost out. It's not a real cash outflow for this period. So I'm going to add back that depreciation. I'm going to take EBIT, which, by the way, do you guys pronounce it EBIT or EBIT?
Both.
Both, yeah. Here's what I found. If I say EBIT, people go, ha ha ha, ha, it's EBIT. And if I say EBIT, people will go, ha ha ha, it's EBIT, right? I just get so tired of their crap, so that's why I call it EBIT, and then I don't have to worry about it. Okay, so we're going to add back depreciation, which tells us how much cash we're actually going to have to spend, and it's going to be over the interest. You can have a times interest earned of less than 1, but have a cash coverage ratio greater than 1 as long as the firm has depreciation. If the firm has no depreciation, then these things are going to be identical. So which one of these is actually more conservative? The times interest earned is more conservative. The cash coverage ratio is less conservative. So who's going to care about these things? Well, our long-term creditors. Why are long-term creditors interested in long-term solvency measures? Because they represent our ability to pay our bills over time. Now, does this mean that long-term creditors are not concerned about our short-term health? No, man. If you don't have the short-term, there is no long-term. We know that bondholders can force a company into bankruptcy. Did you know that suppliers can do that too? Oh yeah. So back in the day, we had Linens and Things and Bed Bath & Beyond. And Linens and Things got themselves in a crack where they couldn't pay their bills. Their suppliers cut them off and actually forced the company into bankruptcy. It wasn't the bondholders that did it, it was the suppliers. And so if you're a long-term lender, you not only want to be interested in these measures, you also want to be interested in the short term. Now let's talk about asset management or turnover measures. Now we're talking about more performance stuff. And the first one we're going to talk about is inventory turns. This is the number of times per year I sell my inventory. It is the number of times per year I sell my inventory. And it's on average, because there will be some things that we sell quite frequently and there will be some things that take longer to sell. We calculate this, by the way, we're trying to get a measure of sales here that we can use to look at our inventory performance. But instead of using total sales, we look at the cost of goods sold. Instead of using total sales, we look at the cost of goods sold. Now, when you get into your strategy capstone class, your management professor may wrongly tell you to use total sales here. Smile politely and go along with what they say, but know in your heart that they are wrong. And here's why. Inventory is accounted for on our books at the cost, right? That's the cost that we go out, with the money that we spend to get that inventory on our shelf. Sales, is it recorded at cost? No, it's recorded at the retail value, what we sell for. So how do I get an apples to apples look here? Instead of looking at total sales, I want to look at the cost of those sales. Because cost of goods sold is recorded at cost and inventory is recorded at cost. Okay, now, if you are running a business, would you prefer for your inventory turns to be higher or lower? Yeah, you want them to be higher. In fact, I said earlier, the only reason we carry inventory is to reduce sales. If I could run a business, at one time I thought I was smart enough to write an app, right? And what would my inventory be on this app that I was going to sell? Right? It's 0. And it doesn't matter whether I sell 10,000 or 100,000 or 100 million, right? Flappy Birds. How much inventory did that guy have? You guys may even be too young to remember Flappy Birds. Okay, you're not? Okay, very good. Is Flappy Bird still out there?
No.
Yeah. The guy was making money hand over fist. In fact, he's from, where's he from? The Flappy Birds guy? Vietnam. And he's making money like, I mean, he can live like above a king in Vietnam for the money he could live like a god, right? And he's like, tired of doing this. Like, what is wrong with you? At least just leave it up there and forget about it, right? Just keep raking in the cash. Okay, whew. The inventory turns for Flappy Birds would be infinite, right? Because it's 0 inventory. I would prefer to have as little inventory as I can. But I've got to be careful. What happens when I start, if I run too low on inventory, what do I start missing out on? Sales. I used to get so mad at Walmart. I would go in there and I had like 12 things on my list. And if I got through the first 3 and the shelves were empty for the first 3, what do you think I did?
Went somewhere else.
Yeah, I went somewhere else. Now, did Walmart at the time realize they were losing my business because of their lack of inventory? No, there's no record of it, right? And so it's a very dangerous, insidious thing. Now, because I try to stay out of Walmart whenever possible, I do that thing where you use the app and they bring that stuff out to your car, right? And then you don't have to deal with the wing nuts inside Walmart because they're there. Anyway, but when something's out of stock, guess what? Now Walmart knows. And it's so interesting because when I first started using that app, probably 5 out of 12 things would be out of stock. Last time I went, none were out of stock. They have gotten better and better and better. It's because they have better data on what they're having stockouts for. And the problem with stockouts, of course, is you lose sales, and if you lose sales, you lose profits. And so you might make your inventory turns too high. It's possible to make your inventory turns too high, but generally higher is better. Now let's look at the days sales in inventory. And we are going to take the number 365 and divide by that number we just calculated, inventory turns. Why 365? Yeah, days in a year. And inventory turns is also in per year because that cost of goods sold is on a per year basis. And so if I take my 365 there and divide by my 12 inventory turns, then I'm going to get roughly 30 days. And that kind of makes sense because there are 12 months in the year. Inventory is turning 12 times a year. Basically, on average, I'm selling my stuff once per month. By the way, I'm going to throw you some real numbers here so you can understand how this all works. I actually, when I went to work for Halliburton, our inventory turns were 4. Our inventory turns were 4. That meant that on average, our inventory was sitting on the shelf for 90 days. We went out and looked at the industry and we benchmarked. That's that competitive analysis thing, right? We benchmarked. We saw that our inventory turns should be around 12, right? And so we can either do one of 2 things to improve this inventory turnover. Either we can triple our sales overnight. Is that going to happen?
No.
Now, we'll talk about that in a minute. Or we can reduce our inventory by 2/3. What do you think we chose to do?
Reduce.
Yeah, reduce inventory. So let's talk about inventory and how it works. By the way, remember I'm a lousy artist. This is a tank. There's a faucet. So basically, we've got water going into the tank and we've got water going out of the tank. If I want this water level to go down, how does this have to relate to this? Yeah, the water out has got to be faster than the water in. If I want that water level to go up, this has to be more than this. It all is the relative nature is what matters. Now, let's call this water inventory. And the stuff that's coming out of here, it's sales, basically. That's how stuff gets out of our inventory. How does stuff get into our inventory?
Purchases.
Okay, purchases, that's one. What's the other?
Production.
Yeah, production. Now remember, I've already told you that increasing sales isn't the answer, and let me explain why. I'll use an example. My sister, when she got out of public service and got into the private world, she was going out and doing sales. And I had already been doing sales, and I was in doctoral school at this time. And we sit down for Thanksgiving dinner with my mom, and my sister had just come from her first sales trip. And my mom says, "Did you sell anything?" And my sister and I both laughed. And here's why. Selling is not like hunting. In hunting, what do? I go out in the woods, I find a nice juicy squirrel, and I shoot it, right? Selling is not like that. You've got to go around and build relationships with people. You've got to figure out what their needs are. You've got to figure out how you can meet those needs. You've got to develop a trust relationship with them. They've got to, you sell yourself first before you ever sell your product, right? They got to trust you. Selling is like gardening. You plan to go out tonight and throw some carrot seeds in the ground, and then tomorrow go out and pull up a nice plump, juicy carrot? No, it doesn't work that way. So whenever you hear someone say, "Oh, we're going to fix our inventory turnover issue by increasing our sales," know for sure that that person is an idiot. Okay, now, can you increase sales? Yes, over time, but it's not going to solve our problem now. So, increasing sales, making this go faster, is not the answer for getting our inventory down. What does that mean we have to do then?
Stop purchases.
Yeah, so we're going to look at these two things. Now, how do I know which of these to do? I examine my inventory, and if I'm a lucky, lucky man, all the stuff that I've got too much of is purchased goods. Because then all I have to do to fix my problems is stop ordering stuff for a while, right? Until the inventory level gets to where it needs to be. And we did that. We did that, and there was some stuff that we could do that with, but the majority of our problem was because of stuff that we made. What do I do then? You slow down production. Now, I used to try to run my guys on around 10 hours of overtime a week. Overtime in the U.S. costs 50% extra per hour, but the reason I did that was if I needed to, I could throttle things back without having to lay off any of my help. Does that make sense? Now, we found ourselves in such an amazing hole that we couldn't just simply come back to 40 hours. In fact, we were having trouble keeping our people busy 40 hours a week. And so we had to go about it a different way. What is the typical way a business will go about that? Layoffs. Layoffs. And in fact, that was the word on lots of people's tongues at the time. But we chose to go about it a different way. And here's why. We were located in southern Oklahoma in a small town called Duncan. And Duncan at the time had a population of 20,000 people. And anytime we had a layoff, when we eventually brought people back, do you think they all came back? No, because Goodyear, the tire company, had opened a factory 30 miles away in Lawton. And some of these guys lived halfway to Lawton anyway. Why do they care where they live? And by the way, people are always going to be buying tires, so I'll go to work for Goodyear, maybe I won't get laid off again. And so we had an incentive to try to keep our people. So what do? we shut down the plant for a week and we put everybody to work, including members of management, cleaning. And we cleaned and we cleaned, and that place was sparklingly clean. And at the end of week 1, we took a snapshot of our inventory. It was down, but not enough. Week 2, we paint. Now we made a bad decision. We let the machine operators decide what color to paint their machines. And when we got done, it looked like those villages along the Gulf Coast of the United States where it's all the different, oh yeah, it was freaky, it was unprofessional. Okay, so then, at the end of that week, we take another reading. And we're getting closer, but we're not quite there. By this time, it is the dead heat of July in southern Oklahoma. And it is hotter than hell. And what do? We send the guys, mostly guys, out onto the property to cut weeds. Oh, that was freaking brutal. We ran through Gatorade like you wouldn't believe. Now, do you think they made management go out and cut weeds? No. I got to stay in the air conditioning. By the way, our factory was air conditioned. Now, here's the really fun thing. At the end of Weed Week, we took a measurement and our inventory is where we need it. And at the end of Weed Week on Friday, we told everybody, okay, on Monday, report back to your usual workstation. I have never seen a group of people more happy to go to work in a factory because they had just lived through triple-digit weed cutting, right? And now they're like, whew! It was amazing how happy people were for about a day or two. And then when they went back to normal. Okay, now, why do I tell you that story? There's many facets to that story. Figuring out whether it's produced or purchased, that's going to impact what you're going to choose to do. And then choosing whether to lay off your people or not. If you're in a place where it's really easy to hire qualified help, maybe you go ahead and lay off people and then you hire back. And that was the way it was with our Dallas factory. The same company. In fact, I had been trained at the Dallas factory, and then I went back to interview at Duncan for a job. And I said that I was in favor of laying people off. And the guy that was interviewing me says, absolutely not. He said, first of all, it's hard for us to hire them back. Secondly, I have to see these people every week at Walmart. Right? Because that's in Duncan, Oklahoma, Friday night, what do? You dress up in your plaid shirt and your big belt buckle and you go down to Walmart and that's the social event. Right? I'm not kidding. Different thing in Dallas, right? Do you think I ever saw any of my workers out and about when I was Heck no. In fact, my plant manager said, I love being here because I'm anonymous. He had previously been a plant manager in a little town in Indiana, and every time he went out to dinner, what do you think happened? Oh, hey, Steve, did you hear about what happened down in the heat tree? Right? No fun. Okay, so that's inventory and how we manage it. Now let's talk about receivables. Receivables turns are how many times per year I am basically collecting my receivables. Now, sales, so it's sort of like inventory. And receivables are kind of like inventory in that the only reason I have receivables is because I want to produce sales, right? Do I really want to loan people money? No, man, I'd much rather that we do a cash and carry kind of thing, right? But if my competitors are doing credit, I have to do it too. Okay, now receivables turnover. Notice that our measure of sales this time is sales. Why? Because accounts receivable is recorded at the price I sell to the customer, and so are sales. So for the same reason, we use cost of goods sold when comparing to inventory. We use sales when comparing to accounts receivable. And I can see my day's sales in receivables. If I have 9 receivables turns per year, 365 divided by 9 gives me roughly 40 days. That's on average how long it takes me to collect the money from my customers. Now, we have other names for this. We also call this the average collection period. We also call days sales receivables the average collection period. Average collection period, or you may see it abbreviated as ACP. You may see it abbreviated as ACP. Now, you want your receivables turnover to be higher, so that means you want the days to be lower, right? But you've got to have something to compare it against when you're looking at days sales and receivables. If I tell you that our days sales and receivables is 59, is that good or bad? You don't know because you're missing a piece of information. Yeah, you're missing what my credit policy is. If I'm telling people to pay in 60 days and my days sales and receivables is 59, is that good or bad? Yeah, that's good, right? What if I'm telling them to pay in 30 days? Is that good or bad? That's bad. Now, when I ask students how to solve this problem, students are like, oh yeah, we can fix that. We'll just give them 60 days to pay instead of 30. What do you think is going to happen?
They're gonna take longer.
Say again?
Take longer.
Yeah, they're going to take even longer. They're either going to take 89 days or they're going to take 119 days, right? They're just going to push it out further. When I was first a supervisor, I had this guy that worked for me named Ramon. Ramon's shift was supposed to start at 3 p.m. Ramon shows up at like 3:09. I'm like, hey, Ramon. He's like, oh, hey, are you the new boss? I'm like, yeah. I said, Ramon, did you know you're supposed to be at work at 3? He's like, yeah. He says, my wife doesn't drive and I have to pick up the kids from school. And I said, well, could you be here by 3:15 every day? He says, oh yeah, I could. And here I was trying to be the young, idealistic manager, and I'm going to help Ramon out, right? I'm like, okay, how about this? You show up at 3:15, and then you just take a 45-minute lunch. He's like, that would be great. And he almost hugged me, but he didn't, and I was glad. Okay, now, what do you think happened the very next day? What time do you think he showed up the next day? 3:30, son of a... Right? 3:30. I'm like, what? Do you see what happens? When I was a kid, the speed limit was, I'm old, the speed limit was 55 miles an hour. Thank you, Jimmy Carter. The speed limit was 55 miles an hour. And how fast do you think I drove? 65. And then, miracle of miracles, they raised it to 65 miles an hour. 75, right? And then they raised it to, 65, 75. And then they raised it to 70. How fast do you think I drive now? 80. I was down in Texas. Have you seen, what is it, 85 in some places?
It's scary.
Yeah. So I'm talking about the actual speed limit, right? So I'm down in Texas, and I see that, and I think it was 85. And I'm like, and I'm trying to do 95, but it just scares the hell out of me. Now, how does that relate to this? If I keep giving people more time to pay, they're just going to keep pushing out. It's naive. Don't be the naive young supervisor thinking that you can solve this problem by just giving them more time. No, it doesn't happen. And then we have total asset turnover. And this is a measure of how well we are using our assets to produce sales. Because once again, would I prefer to have a business with a lot of assets or with no assets? I'd rather have no assets, right? And that comes back to my Flappy Birds game, right? What was the assets there? Whoop, right? Did the dude have to build a factory? No, you have to buy machines? He already had that PC there because he's probably a nerd, right? So, well, we know he's a nerd. Okay, so long story short, if I could produce sales without assets, I would. Given that I have to have assets, then I'm going to look at how well I am doing using this total asset turnover ratio. Now, we're going to learn that you can only compare within an industry, and we'll kind of explain why that is. And so let's say that I am a car manufacturer. Let's look at several different car manufacturers. Right now, Hyundai is selling 100% of the cars that they can make. Or at least they were until the Kia boys figured out how to, right, do their thing. Okay, so they were basically utilizing all their capacity. Stellantis, on the other hand, you guys know who Stellantis is? Okay, so here's what happens when you take every crappy auto company in the world and you put them together. Anybody here own a Dodge or a Chrysler or a Ram? Oh. That is a total piece, man. I don't even have to know what model it is. What model is it? The Charger? Okay. I'm going to catch some slack there, but still, as far as the reliability of that vehicle and the long-term prospects, not the best, right? Now, as a result, Stellantis, let's say they're working at around 65% capacity. Their total asset turnover is not going to be as good as Hyundai's. Hyundai is using their assets more efficiently. Now, you could say, well, we're going to improve the total asset turnover in Stellantis. We're going to increase sales. How do you increase sales overnight? You don't, right? You don't. And in fact, what it means is we're going to have to reduce the assets. How do I reduce the assets at a car company? Yeah, I sell a factory, right? Let's say I've got 4 factories and I'm 65% utilized. I'm going to sell one of those factories and it'll still give me a little space to work with. That's how I get total asset turnover up, is I get rid of these unused assets. Now, let's talk about Stellantis and what they've done. They have recently killed off, is yours a Hemi? You got the 6-cylinder? Oh, you poor guy. Okay. They killed off the Hemi. Now, Dodge has been catering to the red-blooded sports motor enthusiast, right? And they killed off the Hemi. And what do they replace? What's the new Charger like? It's electric. Oh my goodness. First of all, bad move. Secondly, when they finally end up delivering them to the dealership, do you know what happened? They're dead. They can't even get them to move. They get them off the truck and they can't get them out of shipment mode, right? And so they're basically just sitting there. And now they're actually having to offer discounts. When a hot new model hits the showroom floor, are you usually able to buy it for the manufacturer's suggested retail price? Usually you have to pay what? More, right? They call it a market adjustment, right? I call it screwing the customer. Okay. Now, as time goes on and the model, so the initial buzz is over, like for that big Ford Bronco thing. Anybody of you have one of those big Ford Bronco thing? Good. Okay, so as soon as the buzz goes away, then you can get them for MSRP, and now you can buy them at a discount. So what does it say about your janky-ass car that you have to immediately start selling it at a discount? I'm telling you, Stellantis is a crap car company. I admire your car, but in fact, it may be the finest, except for it doesn't have the V8, right? Yeah. Once in your life, man, treat yourself to the best engine you can get. It's worth it. Yeah, oh yeah. And then when you get to be my age and you're driving 35 miles an hour, you're like, I've got 335 horsepower under this hood. Not doing anything with it, but I've got it. Okay, so who cares about these measures? Well, first of all, firm managers concerned about performance. These are the sort of things that Jack and I would talk about every month. And then, of course, our equity analysts and our competitors. Why do our competitors care? Because they're doing what's called benchmarking. They're looking out there. How did we know at Halliburton that our inventory turns were too low? We benchmarked our competitors. How did we know that our receivables turnover was too low? Oh, by the way, let me tell you how to manage receivables. Should you just hope that the people are going to pay? No. So you send them the bill. After 30 days, they haven't paid. What do? Okay, you can charge them, and I'll get to that in a second.
You send the wife.
What's that?
You send the wife.
You send the wife. He's watched my videos. Okay, so you send
So the first thing you do is you call them, right? And you're like, oh, hey, Fred, I see that you are a little bit late on your payment there. I assume the check is just on your desk there. Could you just go ahead and mail that? And usually it works because the squeaky wheel gets the grease, right? Buddy of mine, his dad owned an independent petroleum, they sold gasoline to these little independent gas stations. He said his dad was terrible at collecting, but when he sent his wife, things got collected in a hurry. Because the dad would put up with things like, oh, Junior needs a new pair of shoes and all that. And Mom, who had 6 boys to put shoes on, she wasn't taking any of that crap, right? Now, is it the same to send them an email? Oh, I'm sorry, that must have gone to my junk, right? Is it the same to send them a text?
No.
WTF, right? No, it's the phone call. And in fact, if you're next door, go over and take them a cup of coffee. Hey, why don't you pay your bill? Does that make sense? So I was doing, I'll tell you this quick story, we'll get out of here. I was doing some pro bono consulting for this group. Pro bono means free, right? And I looked at their days sales in receivables, and it was doing this. This was during the financial crisis. And I said, let me guess, you think of your customers as friends? And they said, yeah, how did you know? I said, because your friends are taking advantage of you. And they were like, but they're our friends. And I said, I don't need friends. I need paying customers, which I thought was funny given that I was doing pro bono consulting. See you next time.